Activity ratios. So now let us take a look at turnover ratios or activity ratios. Activity ratios, what do they refer to, students? The frequency with which, the ease with which an organization converts its assets to cash, to sales. It indicates how efficiently are you using your assets. A higher ratio means with a lower investment, greater sales could be generated. Now, say for example, a very simplistic kind of example, if I take, I put in $10,000 and I generate sales of 10,000 in the first month. Now, since sales is being generated, I get some money and the same money is rolled over for sales for the next month and the next month and the next month, and it goes on. So my investment was $10,000, and after that I managed to generate 10,000 sales each month for 12 months. So what is my total sales? My total sales was, let us say, $120,000, right? 10,000 each month. What was my investment? 10,000, right? So this 10,000 that I invested got rolled over 12 times, got turned over 12 times. Are you following? Now suppose I generated $120,000 dollars of sales by putting in $20,000. What would it mean? It would mean that the turnover is 6 times. Which do you think is better? The person who has generated sales with $10,000 or the person who generated the same sales with $20,000? Obviously, higher the turnover, greater is the efficiency. Follow? So an activity ratio indicates how many times a particular asset is turned over into sales. Inventory, how many times is it being turned? Cash, maybe fixed assets, maybe total assets, maybe. What is the debt collection period? How long debtors how long does it take for the debtors to pay up? How do they remain, as how many times is the debtors turned over into sales? Both current assets and non-current assets may be used to generate sales, and activity ratios are nothing but ratios which try to indicate the efficiency with which a firm is generating sales by using its assets. Usually higher the ratio, the better it is, because it means with smaller investment in assets, I am able to generate more and more sales. Of course, it can never be too high, because then there could be other risk of maybe stock out, not enough, not being able to support the sales, not being able to grow as sales improves, and so on and so forth. But overall, so what you need to know is activity or turnover ratios are a measure of the efficiency of the organization, the efficiency with which it utilizes its resources. Okay, the efficiency with which the assets are utilized. So we will be studying these activity ratios under different heads. We shall start with the inventory turnover ratio, the receivables turnover ratio. Once we sell to the debtors, once we sell, if it is a credit sale, it takes time for it to be converted to cash, right? The receivables turnover ratio. The payables turnover ratio, on the other hand, when we buy materials, we may not pay immediately. We may pay cash after a month or 2 months, whatever is the normal terms of credit. Yes or no? To that extent, I don't need the cash immediately. Of course, all these three add up to in a way, to the working capital ratio: inventory, receivables. Working capital, of course, may also include cash, etc. But largely, these, you can say, represent a large chunk of the working capital. You remember, these are your current assets and this is your current liability. You also arrive at an operating cycle and a cash cycle with the help of these ratios. You can find out inventory turnover ratio helps us to know how long the inventories are kept at our place, how long does it remain in stock before it gets converted into sales. So it's a kind of holding period. Holding period. Similarly, receivables turnover ratio gives an indication of the collection period. If you add the two, you get the operating cycle. From the operating cycle, if you subtract the credit period on an average, which is allowed by our suppliers, we get also the cash cycle. The fixed assets turnover ratio, the total assets turnover ratio. So we can compute turnover ratios. Usually the numerator is either the sales or cost of goods sold divided by the inventory or the receivable or the total asset or the fixed asset, whatever it may be. This is how turnover ratios are computed. So let us do them one by one. Try to interpret each of them. Inventory turnover ratios. So inventory turnover ratio indicates what the on an average how many times the company sells its average inventory. It is normally taken as the cost of goods sold. Cost of goods sold, because if you take sales values, then if there is any change in selling price, it affects this ratio, though that really has nothing to do with the average inventory. What is average inventory? We take opening inventory plus closing inventory divided by 2 in case there has been a change in the level of stocks. So it is better to take what we think would have been held throughout the year, which may not exactly be the opening, may not exactly be the closing, but an average of 2 is assumed to be indicative. Got a small problem, students. Compute the inventory turnover ratio when the opening inventories are 5,000, closing inventories are 7,000, and the annual cost of goods sold is $48,000. So what is the average inventory? 5,000 plus 7,000 by 2, that's 6,000. The annual cost of goods sold is 48,000. 48,000 by 6,000. 8 times. We say the inventory gets turned over 8 times. The inventory gets turned over 8 times. Students, it is no big deal to remember turnover ratios. Remember, it is sales by inventories. Now, in case of inventories, we don't normally take sales, we take the cost of goods sold, because that would be a better indicator that you have an average inventory of 10,000. Since we hold the inventories maybe for 2 months, it's actually turned over 6 times. Followed? So that for that we don't take the sales figure, which has a profit element. What we take is actually the annual cost of the goods sold. Now, the inventory turnover ratio may also be expressed as what? Days sales in inventory, or it's also known as the inventory holding period. Inventory holding period. How do you do that? 365 days by inventory turnover ratio, or we could take it as 12 months. 12 months. If you say 12 months by the inventory turnover ratio, then you get the solution in months, or if you take it divided by 365 or 360, sometimes they take 300 because 300 may be roughly the number of working days. So the inventory turnover ratio, when it is expressed in days, in a period, in days or months, day sales in inventory tells us, it gives us an indication of the holding period, the average number of days that the inventory items remain in stock. So the same problem, we already knew it was 8 times, right? The inventory turnover ratio. So 365 days by 8 is equal to 46 days. 365 days by 8, 46 days. Or what is the other way? Or maybe you could do 12 months, right? 12 months divided by 8. And what would you get? 1.5 months. That is nothing but 1.5 months. Whichever way, the same thing. 46 days or 1.5 months is one and same. Whichever way you express. What are the implications of this? Usually, higher the inventory turnover ratio, the more efficiently the firm is able to convert its inventories to sales, thus increasing profitability. Higher the ratio, which ratio? The inventory turnover ratio. Higher this ratio, lower the holding period, right? Then it is better. Lower the holding period. Now, if inventories accumulate and there is no increase in the sales or the cost of goods sold, then the inventory turnover ratio comes down, indicating that there is a pile up of inventories. Yes or no? Pile up of inventories which you are not able to sell. So higher inventory ratios, we normally look to higher inventory ratios. The higher the inventory ratio, the faster the inventories are getting sold. We are far more agile. But if there is an increase in the pile up of inventories without a corresponding increase in sales, it shows that for some reason the turnover ratio has fallen. It is not a good sign, and we need to see whether sales have fallen or what is the reason. Follow? Of course, if we go on decreasing the levels of inventories so that this ratio can be vastly improved. But again, there is always a limit, because if you reduce it a lot, there may be conditions of stock out, which is of course not at all desirable, because it leaves us with unsatisfied customers and we may lose our customers to a competitor. Once we arrive at this ratio, then we can make comparisons with the earlier period, maybe of the same company or with other companies of the industry, other similar companies in the same industry, in order to see how we compare. Are they more efficient, or are we able? Are we nimble? Are we agile? Are we able to turn over our inventories quickly into sales? Next, let us look at receivables or debtors turnover ratios. What does this tell us? This tells us the average number of times the receivables are collected during a year, and roughly the formula is, I told you, everything is sales by the particular asset. So we had inventory turnover ratio. It is, instead of sales for inventories, what did we use? We used the cost of goods sold by the inventories, but we take average inventories, since not the closing, because that could just be those inventories are just for one day. We're not sure. To make it to find out what was the average inventories held during the year, we take a rough measure. What is a rough measure? Opening plus closing inventories divided by 2. And of course, average trade receivables. Credit sales, mind you, credit sales, because we don't need to collect debt. Receivables come from credit sales. Net of returns and discounts. Receivables, again, we take opening plus closing by 2. And the assumption is that the sales occur uniformly during the year. Otherwise, if they are seasonal, then we may have to take the monthly totals, and then arrive at an average figure. Gross receivables are taken and provisions for doubtful debts are not deducted. We do not deduct any provision for doubtful debts. Clear receivables turnover ratio, annualized credit sales. Why do I say annualized credit sales? In case sales for 3 months, 4 months, etc. is given, convert it to a 12 month, convert it to an annual sales. What would be the sales for 12 months? Use that figure to find out the receivables turnover ratio. From the receivables turnover ratio, we come to the debt collection period, which is nothing but 365 days divided by the receivables turnover ratio. 365 days, or like I said, we could always take 12 months. We could also take 12 months. This is the average collection period. Suppose the average receivables are 120,000 and the annual credit sales is 960,000. What does this mean? Then the receivables turnover ratio would be 8 times, and again I get 1.5 months or 45 days. I've taken 360 days here just for ease of computation. What is that? The average collection period. Days sales outstanding in receivables, the collection period, whatever you call it. Once the debt collection period is computed, again you can compare it with the credit terms of the organization. So when we look at the average, if we get something like a debt collection period of 4 times or a debtors turnover of 3, then we look at what is the standard and what were our credit terms. We normally have said that we would give 2 months credit on an average. Then why do we have a 4-month credit period when we compute the average collection period? Is it clear? That's when we need to look at into it. And then we see why is it that our debtors are not being collected as per the policy. Why do most of the debtors seem to be extending the period of credit? Higher the turnover ratio and shorter the collection period, the more quickly the firm is able to recover money from its debtors. A decrease in the receivables turnover ratio indicates slower collections. A low collection period may be encouraged by offering discounts, etc. So if I want to improve, one thing that may be suggested is offer discounts for early payment so that people make use of that. Maybe then money may come in faster. But remember, we must always think of both the pros and cons. We cannot we cannot draw conclusions and immediately jump to taking policy actions. We must understand that if we decide, if we become strict about the credit terms or reduce the credit period, it is quite possible that we may lose some of our customers. We may lose some of the customers. Next, let us do the payables turnover ratio. The accounts payable turnover ratio indicates the efficiency of the payment to the suppliers. So are our suppliers paying us on time? When you take the credit purchases by the gross average accounts payable. Average payable always opening plus closing divided by 2, assuming that the purchases occur uniformly. Purchase, of course, is cost of sales minus opening entries plus closing inventories. It may be difficult to ascertain the purchases from the financial statement figures, right? So we may have to look at the cost of goods sold or take the cost of sales and subtract the opening inventories, add the closing inventories. We get a figure pretty close to the purchases. Again, the same thing we can do. We can look at the days purchases in accounts payable, that is the average payment period. Yes or no? This is nothing but the average payment period. And how is it measured? The average payment period, 365 days in a year or 12 months in a year divided by the payables turnover ratio. Once the average payment period is computed, it may be compared with the credit terms which are offered by the suppliers. Higher the turnover ratio, shorter the payment period. It indicates that the firm is making payments to its creditors early. Yes or no? So once we get the average payment period, what do we see? We look at the credit terms which are offered by the suppliers. If they offer greater credit terms, longer credit terms, we may decide to extend the credit period. Now, if the turnover is higher, it means that we are paying our suppliers very promptly. Now, sometimes a company, in case of a payable turnover ratio, may prefer a lower ratio, not a higher one, a lower ratio so that it has liquidity for some time. Messrs. Jupiter can supply goods on credit to either customer A or customer B. The relevant details for the year ending 31st December are given to us. Average payables is 300,000 and 160,000. Purchases are 930,000 and 6,60,000. Sorry, it's moved, students. Cash purchases 30,000 and 20,000. Okay, 930,000. Total purchases are 930,000 and 660,000. Got it? Cash purchase 30,000, 20,000. Advise with reasons which company customer Jupiter should prefer to deal with. Advise with reasons as to sorry, which customer Jupiter should prefer to deal with. So we compute the payables turnover ratio. In case of customer A, it's 3 times, customer B, it seems to be 4 times. Average payment period is 3 times, right? So 12 months by 3, that's 4 months, and 12 months by 4, that is 3 months. Yes or no? So customer A, so if Messrs. Jupiter, if he needs to supply, he will prefer to supply to B, because B will make payment faster. Jupiter would prefer the customer B with a shorter payment period, right? So this is from the view of the supplier. Supplier can give goods to either A or to B. The supplier will prefer the company which will make payment to him in a shorter period of time. Let us next look at the operating cycle. The operating cycle is the amount of time it takes to convert an investment of cash in inventory back into cash through sales and subsequent collection of the receivables. What does this mean? Now, first, we pay cash and we buy materials. Okay, so materials come in. Sometimes, if it's a manufacturing concern, these materials have to be worked on. So there'll be some labor, some overheads. All this is done, and after so first, if we buy materials, it stays there for 1 month. 1 month materials as materials inventory, it stays for 1 month. Then it goes into work in process and it remains in process for 1 month. Then it becomes a finished good and remains as a finished good for 1 month. And finally then it gets sold. When it gets sold, it may become a debtor, right? It gets converted to a debtor. So 1, 2, 3, right? This. For 3 months, the inventory remain. We call this the holding period, whether in the form of a raw material, whether inside the work in progress or a part of the finished good for 3 months. And then even when you sell to the debtor will pay only after 2 months. In that case, the operating cycle is 1 plus 1 plus 1 plus 2, that is equal to 5 months is the operating cycle. This is what we mean by the operating cycle. It's the inventory holding period plus the debtor's collection period. Followed the period for which we are holding the inventory in the form of maybe raw materials, work in progress or finished goods, and the debtor's collection period. So by the time it is converted to cash, number of days sales in inventory plus number of days sales in receivables. This is how the operating cycle is, students. Say cash to buy raw materials, goes to work in progress, goes to finished goods, and gets converted to sales. Till such time, this period is the holding period. From the sales, it becomes receivables, but from receivables to cash again takes time, right, students? So that's what is that called? That's called our collection period. That's called our collection period. So sales become receivables, and they by the time this period till the goods are sold and they become cash. That is called the collection period. This is an operating cycle. While this is an operating cycle, you must understand, students, when we buy raw materials, very often we buy the raw materials on credit and we don't have to pay the cash upfront. Yes or no? So to that extent, there is a relief, and that is called the cash cycle, the operating cycle minus the credit which is given to us by our suppliers. The credit which is given to us by our suppliers, that would be called a cash cycle. Okay. Compute the operating cycle of this textile mill from the following data. What do we get? The average receivables, this is for year 2 and year 3. 3 plus 4 divided by 2 and 4 plus 6 divided by 2. This is for year 2 and this is for year 3. Okay, so this is the average receivables, and the receivables turnover ratio is the sales divided by the average receivables. Sales divided by the average receivables. So this is 1.4 million by 350,000 and 1.8 million by 500,000. So we get a receivables turnover of 4 and 3.6. Therefore, what is the debt collection period? It is 360 divided by 4 or 90 days, 360 divided by 3.6 or 100 days. If you want the inventory turnover ratio, you take the average inventories year 1, 190 plus 240 divided by 2, 240 plus 350 again divided by 2. $190 plus 240. This should have been 240 plus 350 as far as I can see. I hope I've not made an error in the calculation. Yeah. 240 plus 350, that's equal to 590 divided by 2, 295. So I made a mistake here in the sense we've taken inventories as 190, 240, that was 350. I've taken it as 300 here. This here might change a little, students, right? This is correct, 190 plus 240 by 2. But there could be a small variation here. Again, I repeat, it's 240 plus 350 divided by 2, giving us 295,000. No, so the computation is correct. 350. Inventories turnover ratio is the cost of goods sold which is given to us, 1.2 million divided by the average inventories. If you take the holding period, you get 64.5 days and 71 days. 360 divided by the inventory turnover ratio. The operating cycle in that case would be the 90 plus 64.5, 154.5 days, 100 plus 71, 171 days. Now the operating cycle, if you have too much inventory, high inventory, it means there is a lot of carrying cost, right? There is the cost of storing, there is the rent payment, there is money blocked in, there is a risk of obsolescence and so on and so forth. If you have too little inventory, that is a big problem because there is a chance of stock out, missed sales. That is really sad. We lose customers, we lose potential customers. Similarly, as far as debtors are concerned, if we have a very relaxed policy, then we don't have enough working capital. Financing costs are more. But if we insist, no, money has to be paid up within a month and we're very strict, we may again lose some customers. Cash cycle, like I mentioned, is operating cycle minus the payables payment period. This represents the period for which the company does not have cash. Cash cycle, nothing but operating cycle minus the payable payment. Since we've done this, we could also do a working capital turnover ratio, which is nothing but sales by working capital. And obviously, we prefer a high working capital turnover ratio because with a smaller amount of capital, it means we are generating greater volume of sales. It would indicate business is running efficiently and therefore it has a competitive advantage. However, we should not be blind. We should not try to increase this to the maximize. We cannot try to maximize this. A very high ratio could indicate that the business does not have enough capital to support its sales growth. Correct? If we see it in combination with the high payable ratio, then we definitely know that the company is going to have certain liquidity issues. We have other activity ratios also, students, nothing big. You could take fixed assets turnover ratio, you could take cash turnover ratio, so on and so forth. Like I said, sales divided by the fixed assets. Again, when we take fixed assets, inventories, receivable, we don't take it as on a particular date. We try to take an average for throughout the year. And for that, we take the opening plus closing divided by 2. Net sales by average fixed sales. That's a fixed assets turnover ratio. Higher the ratio, the greater the efficiency. Fixed assets are normally taken net of the depreciation cost. Similarly, we could have a total assets turnover ratio which measures the efficiency with which total fixed and current assets were used in the firm. Total assets turnover ratio is net sales divided by the average total assets, and higher the ratio, greater the efficiency. A quick recap, students. I've not covered it this time. I hope you are able to compute without looking at the right side. The total assets turnover ratio, logically total turnover by next fixed asset. Students, I'm sorry, there is a mistake here. This turned back. This is turnover by total assets, right? Students, turnover divided by total assets, not capital employed. Turnover divided by total assets. Fixed assets turnover ratio, turnover by net fixed assets, that is less of accumulated depreciation. Working capital, turnover or cost of goods sold divided by the working capital. We normally prefer to take cost of goods sold because working capital is used to make the goods, and therefore cost of goods sold minus the cost of goods sold without including a profit element when we sell to the customers is preferred. Inventory turnover ratio is the cost of goods sold by the average stock. Inventory holding period 365 days by the inventory turnover ratio. Similarly, debtors turnover ratio, you take the credit sales by the average accounts receivable, and for the collection period, divide 12 by the same. That is 365 or 12 months, 365 days or 12 months divided by the debtors turnover ratio. The creditors turnover ratio is with relation to the purchases. Don't make a mistake there. Credit purchases by the average accounts payable, and you could also compute the supplier payment period. You also have the operating cycle, and you have something called the cash cycle, which is nothing but the inventory holding period plus the debt